Welcome back, everybody. Rounding out our conversation on prospect theory. And we're going to be talking about in this video mental accounting. So, this is how we categorize our money and our spending and how we categorize financial events that happen. And we're also going to talk about how we overweigh low probabilities in our decision making. So, when we're looking at categorizing money. So typically, we're looking at this mental accounting in a suboptimal or a negative light. So if you think about having $10,000 in a savings account, and that savings account is earning right now, as I'm taping this in 2024, we're getting 5%. Take it in a money market. So don't put it in your checking account, get that money in a money market. So at least in the US, we're earning a yield of around 5% on our savings. And at the same time, this same individual has $10,000 in credit card loans. And this is their credit card debt. They're paying probably around 25% per year on this debt. And so they have the savings and they have the debt. And the way that they categorize it, though, is they'll say, I just really like the, the security that the savings gives to me. But in reality, I'm looking at this going, no, that is suboptimal. And the way that you are mental accounting, your mental accounting is taking you back about 20% each year that you continue to hold on to this. So my advice is lop this credit card debt up off and then build your savings up over the next year, or at least give yourself maybe a little like $1,000 buffer and then wipe out the rest, because the way it's set up here is being categorized incorrectly. So you can see that sometimes in a number of different ways where it's not the optimal way to go. Conversely, you might see somebody who has a really low interest rate on their house. And if that's at 2.5% for your mortgage rate, and you can get a money market for 5%, it doesn't make sense, like on paper or mathematically, to aggressively pay off that mortgage. And so the rational thing would be to take that, put your money in the money market account, and then use any extra money from interest earned on that to pay down your loan, but not pay aggressively down on your loan. But some people like the idea of, in this original scenario, they like having the savings. Conversely, with the mortgage, there's a mental benefit of having no mortgage or having everything paid off. And I totally understand that, but I'm just trying to point out some of the ways that our mental accounting can be suboptimal. Next, though, we have spending. And this can be an interesting way to go too with our spending. But first, what about sitting through a bad movie? If you have a bad movie that you've ever sat through, you've paid your money to get in, and the popcorn's paid for, you're sitting there and you realize popcorn's already eaten and it's a bad movie. Don't see much hope for it turning around. What do? Do you stick it out, or do you leave and try to find something better to do? And so this is what we call in the movie theater, this is the sunk cost effect. So you've already sunk the money into your ticket. So whether or not you sit for the remaining hour and a half of a bad movie is up to you. But the rational thing would be to use that next 90 minutes to do something potentially more enjoyable or productive than being in misery. But many people say, I've already paid for this. I'm going to be in misery all the way to the end. There's your sunk cost effect as well. So there's a sunk cost effect that is, we talk about movies, but you see that in business as well. Somebody starts a project and they realize this is going to be a really not not profitable, bad project. It's going to cost a lot of money. And instead of cutting that project They say, no, we're going to get all the way to the end. I don't care if it already is going to lose money. So we see that in movies and in business as well. Additionally, with spending, what happens when you get a tax refund? In the United States, we get tax refunds from time to time. And do we treat that money the same way that we treat our paychecks when we earn it? Our paychecks, we usually know where it goes. But when we get a tax refund, the way we account for that, it's almost as if we got free money. And so we go then and spend it more frivolously than we would on our normal paycheck. And so we can see that with our tax refunds. Same thing. What about with like birthday money? So birthday money, you get that. You don't treat that the same way, or you spend that the same way that you would with your normal paycheck as well. Oh, tax refund, birthday money is all going to be spent. Again, we're all talking about how we categorize our mental accounting, B-day money, and then around the spending here as well. What about if you have a windfall? So if you're betting and you suddenly have new money, you started with $100 and you now have $500, but you're 400 in the black in profit. So do you treat that additional money the same way that you would any other money? Now you should, right? That's what the traditional economists and finance would say. Each dollar should be treated the same way. But no, of course not. This is the house money effect. So if you have house money in your pocket, you treat that totally separate than even your original $100 that you put in. And you're going to be way more risky with that additional money. And this is the house money effect. The way we interpret that. All right. And then financial events. Now, this actually goes through a little bit of reference point dependence. So remember, prospect theory is all predicated on a reference point. How we determine gains and losses all depends on the reference point. Well, reference points can actually change over time. And so I was working the phones for a financial broker over the financial crisis in 2007 and 2008. And I would get call after call yelling at me. I've never met them before, but they're yelling at me because I lost 40% in their account. And so I'd go back and I would look, and they'd been investing for a number of years, and they started at $10,000 in their account. And over the years, this thing has grown to $500,000. And so it was at $500,000. And then during the financial crisis, it went down to $300,000. So they're calling me with $300,000 in their account, yelling that I lost them 40% of their account. And I realized that reference points can change. And because if they didn't change, they would have called me that day and said, thank you very much for increasing my account 30-fold over the last couple of decades. But of course they didn't. They were looking at the higher new reference point, and now we're feeling the losses, and they were pushing that feeling onto me on the phone. I would take call after call around that. And so we can see reference points change. And I am a big proponent of trying to keep people's reference points low. So that means I can only exceed those. When they get too high, then I increase my probabilities of underperforming and underachieving that. And so I'm always constantly negotiating that and making sure everyone's reference point is under control with those financial events. Final point around the financial event, hypothetical here. It never happened to me, but I think about this. Do you change your reference point? You start with $10 and you go to the Bellagio in Las Vegas, the big, nice casino, and $10, and you put it on a real long shot and you win $50,000. So you're walking around with $50,000 and you decide to try to double it. You put it all on black on the roulette table and it turns up red and you walk away with $0. Now, you go back up to your room after all of that. What do you tell your friend, your spouse, your significant other? What do you tell them? I'm going to start off the phrase, I lost blank. So you have to name your number. So if you said, I lost $10, you did not change your reference point. If you lost $50,000, then you adjusted your reference point and felt that even more. I think my answer would have been, I lost $80 because what I would have done is I would have only recorded this, but then I probably would have slammed about $70 worth of alcohol before I went back up to the room and probably had a good cry and then did my statement of $80. Final section here. We overweight low probabilities. Now, we've seen this when we were back in our original videos talking about the low probabilities for both gains and losses, that we will really overweight. We think it's a 0.1% chance happening. That is 1 in 1,000. And we will say in our minds, we interpret this as that is way more likely than it's really going to happen. If you don't believe me, think about our forecasts that we look at. There's a small chance of rain, and there might even be a little picture, but then you realize it's 5%, small chance of rain. How do we interpret that? A lot of people go, oh, it's going to rain. We make these statements, it's going to happen. And so we take the small probability and we really overweigh it. Same thing if we're taking any medication. Oh, there's some side effects, which means in some trial, somebody must have had some little side effect. And so, of course, the probability is very small on a lot of these cases. But the way that we interpret this is, oh, look at all these side effects that I'm going to have, or I'm very likely to have by taking this. So again, this is our overweighting low probabilities that I want us to remember as well as we move into our final application section of all things prospect theory. This is where we're going to put some more application to our learnings of what we've already have digested at this point. Well, thank you very much, and I look forward to seeing you on the next video. Take care.